Let's finish up Chapter 14, studying ways other than cash dividends that firms can use to distribute cash to shareholders. Cash dividends are the most fundamental way of distributing cash to shareholders, but firms can elect to employ stock repurchases, stock dividends, and stock splits as other ways of more or less sharing their success with their shareholders. When a firm repurchases its own stock, the market usually perceives it as a positive signal. There are several reasons why a firm might elect a stock repurchase: as an alternative to distributing cash as dividends, to dispose of one-time cash from an asset sale, to make a large capital structure change, or to use when employees exercise stock options. Firms usually give the reason that, quote, their stock is undervalued, unquote, but it could also mean the firm has no good investment opportunities and needs to distribute some cash to shareholders. As listed on the slide, stock repurchases are also employed along with debt issues to make major capital structure changes, coming up in Chapter 15. Firms publicly announce their intention to repurchase their stock. There are three ways the repurchase can work. A trustee can be appointed to make purchases in the open market up to a specific dollar amount. The firm can make a public tender offer, asking shareholders to tender their stock at a specific price. The firm can make a targeted repurchase of shares from a specific stockholder to eliminate him, green mail. The firm is under no obligation to carry through with an announced repurchase. Continuing with IWT from the mini case, they've decided to distribute $50 million to their shareholders, presently held in short-term assets. We'll look at the impact of making this distribution as a cash dividend versus as a stock repurchase. The intrinsic value of the stock before any distribution is shown in the table above, $16 a share. This is found as the value of operations plus short-term investments minus debt is the value of equity divided by the number of shares outstanding. Note that the share price declines by exactly the value of the 50-cent dividend. It does not happen exactly like this in real life. The stock price actually declines by about 90% of the dividend. But the point is, the market value does decline. If it didn't, there would be an arbitrage opportunity, assuming no taxes. Let's be clear. The actual repurchase itself has no effect on the stock price. Remember, the market moves on news. The announcement of the repurchase is news. The execution of it is not. If investors think the repurchase will drive the stock up, then they'll buy before the repurchase. If they think it will drive it down, they'll sell or short. To figure out how many shares IWT repurchased, we can use the formulas on this slide. Assuming the stock price stays constant, the number repurchased equals the cash to be distributed divided by the stock price. For IWT, the number repurchased equals $50 million divided by $16, 3.125 million shares, leaving 96.875 million outstanding. This demonstrates that the repurchase has no impact on the stock price, assuming no pre-repurchase price pressure. The value of operations is unchanged. Short-term investments are now zero, as the funds were used to execute the repurchase. Debt is unchanged. The number of shares has declined, yet the intrinsic value of stock remains constant at $16. These results are recapped on the next slide. Bottom line, stock price and shareholder wealth are unchanged by the share repurchase. Looking at a stock repurchase versus a cash dividend, we see major differences. With the repurchase, the stock price stays constant, but the number of shares declines. With a cash dividend, the number of shares remains constant, but the share price declines. This graph demonstrates that over time, cash dividends tend to depress the stock price below that which would have been maintained with stock repurchases. Stock repurchases definitely have some advantages over cash dividends. Mainly, stockholders can choose to sell or not. Thus, they choose whether to pay taxes or not. Assuming they've held the stock over 1 year, any gain will be taxed at the lower long-term capital gains rate. Stock repurchases are typically viewed by the market as a positive signal. Alternately, the repurchase could be viewed as a signal that the firm has no good investment opportunities, else it would use the funds for those. If the IRS views a repurchase as a tax avoidance tactic, penalties can be imposed. In conclusion, dividend policy is a big decision for a firm since dividends are sticky. Once you start paying them, investors expect them and expect them to grow. Using the residual distribution model to establish a target payout percentage is a good start. Most executives agree that dividend stability is critical to maintaining good investor relations. Firms have other ways of rewarding investors. They can pay a stock dividend, which increases the number of shares outstanding without changing the equity position of any shareholder. Or they could announce a stock split, again increasing the number of shares outstanding without changing a shareholder's equity. Both stock dividends and stock splits increase the number of shares. Assuming no news announcement accompanying either action, the stock price falls to keep each investor's wealth unchanged. As the slide says, there's a widespread belief that a price range of $20 to $80 is optimal for common stock. The thinking is that the average investor can handle a round lot, 100 shares at $20 to $80. This is completely ignored by Warren Buffett's Berkshire Hathaway, up in the hundreds of thousands, Google, and many others. Stock splits are generally considered to be a positive signal, so though the stock price immediately declines, it may rise after the split as a reaction to increased investor confidence. Many firms offer dividend reinvestment plans, or DRIPs, which allow investors to automatically use their dividends to buy more shares in the company. In an open market purchase plan, a trustee pools all the dividends to be reinvested and then buys shares on the open market. Shareholders can use a DRIP for 3 reasons. Brokerage costs are reduced by the volume purchases. The DRIP is a convenient way to invest excess funds, and the company generally pays all administrative costs associated with the operation. In a new stock plan, the firm issues new stock to the DRIP members in lieu of cash dividends. No fees are charged, and many companies even offer the stock at a 5% discount from the market price. Sometimes firms allow optional additional investments from current shareholders via the DRIP mechanism. Firms that need new equity capital use new stock plans, while firms with no need for new stock use an open market purchase plan. Firms can switch back and forth between open market and new stock plans as their need for funds change. This ends Part B of Chapter 14.